Welcome to Southern Podcast. We are currently witnessing significant turbulence in the markets driven by geopolitical tensions and global uncertainty. For average retail investor, this can be quite confusing and can lead to challenges with respect to whether to stick to current investment plans or make changes with respect to market ups and downs. To make sense of all this, today we have with us Ms. Divya Menon from Axis Mutual Funds with over 16 years of experience in this in with
With
over
over
16 years
16,
with over 16 years of experience in this industry, she brings with us great insights to guide us through these turbulent times. So, Ms. Divya, welcome to the podcast.
thank you.
So,
Thank you
my
so
first
much.
question, yeah. So, my first question to you is: in view of the current turbulent markets, including the Indian stock markets, what advice do you have for our investors?
Okay, so this is the most asked question nowadays. In fact, incidentally, if you go back, exactly a year ago, last September, somewhere around the last week of September, was when Nifty had actually peaked out. And since then, the journey has been full of ups and downs. So some weeks, some months were good, some were bad, and net you are sitting kind of like on a flattish return or negative return, to be very honest. So markets have been turbulent. A lot of it is driven by global aspects. The US tariffs, the policy shifts that we are seeing coming out of US. Then there are geopolitical threats that are happening. So there are a lot of external factors that are coming into play in the domestic Indian market, Indian equity market. But fundamentally, if you look at our Indian market, you will see that our fundamentals are strong. Our macroeconomic setup for the country is strong. Corporate fundamentals are strong. There is a huge bump up in the financialization of saving story. So people are saving and people are investing into financial asset classes that we are seeing, right, with the number of SIPs that are coming into market, the number of investments that are happening into mutual fund markets. All of this say, point to the fact that fundamentally, domestically, we are a strong economy. So there's nothing to really worry about in terms of turbulence. But my advice to all investors would be stay put, stay invested, have a long-term view. Now, those of the investors who have been in the market for a decade, 2 decades, 3 decades, so on. So essentially, they have seen the cycles. They would have probably seen the 2007, 2008, the GFC crisis. They would have probably seen the COVID crisis. So all of them are somewhere aware that markets go through cycles. In fact, what we saw in the last 1 year was not even a significant drawdown, right? But there are times when markets fall significantly and for a longer period of time. That's not what has happened recently, but that is something people should be aware of. Often I have heard people use this term, for investing, like investing is not a sprint race, it's like a marathon. Now, I have an avid, enthusiastic Formula One racing uh, person in my family. My son is an avid follower, but while I do uh, understand the nuances of Formula One racing, mapping itself to investment story, I'm not an avid fan. So I could go off in terms of how I'm trying to relate Formula One racing with investing, but mostly, it is when you look at that Grand Prix or the race, you understand that it's not about winning that one first lap, right? It is about being steady, being strategic, being focused on the multiple laps that you have to cover. So it's also not about having the fastest car in the race. There are many factors that influence your success. So if I were to draw parallels between, say, between racing in Formula One to investing in equity markets specifically, you have Formula One car, which people think is the most important thing. But by the way, while it is very important, it is not the only important aspect. So, car is like your asset allocation, right? What is the right balance you have in your portfolio? The tire, the fuel, the aerodynamics, all of this together is your car setup. That's your asset allocation in your investment parlance. But then you also have to face the weather conditions during the day. It could be changing, which is what you would consider in terms of market as volatility. Then you have, you have to be consistent lap by lap by lap. That is your SIP strategy. Then you have to not just be doing all this, but you also need somebody as an engineer or strategist in your team who's going to guide what your strategy would be, who's going to monitor your performance, who's going to help you make crucial decisions during your race. That is someone like your financial advisor, MFD, that is your sathi, right? So all of the parallels I can draw, but one key advice, especially coming back to your question, that current volatile, turbulent times, what should the investor do? I would just say stay put, stay invested.
That was a very thoughtful insight. My second question to you would be, what, according to you, are the three golden rules for managing investments through these good times and bad times?
Okay. So, Samruddhi, I think between us or those in the financial industry, financial world, they would have heard of this golden rules, three rules, four rules multiple times. But trust me when I say that when I meet young professionals, especially young kids who are just getting into jobs and all, they are really clueless about this, what we feel are, the universal rules, the timeless rules, classic rules of investing, but most of them are clueless. Fairly very easy to understand, fairly very easy to imbibe in ourselves. So I'll just, lay it down there for our listeners. So rule number one is diversification. Now, I can, put it very simply in the age-old wisdom of do not put all your eggs in one basket. So that's something I think most of our listeners would relate to and quickly understand what I mean by that. Now, traditional asset classes like, say, equity, fixed income, gold. Now, do you really think all of these asset classes will, move in the same direction, move up in the same direction, move down in the same direction? No, right? So the last few years, until last year, it was all about equity. This year, if you ask people, it is all about gold, it's all about silver. But really, what you need to look at is how you can diversify your portfolio. You don't want to be putting all your eggs in one basket. That means you don't want to be investing just because gold has done well. You don't want bulk of your portfolio to sit in gold. Sorry. So, so the idea is that be aware of your risk appetite, be aware where you want to invest, diversify your portfolio, so that even if times are volatile, something or the other in your portfolio will work. So it will act like a cushion or act like a buffer. So, for example, in 2020, when there was the COVID crisis, equities fell very sharp. But at the same time, gold and bonds did well. So, had you been diversified at that point in time, you would have had lesser shock in your portfolio. So, that's the beauty. And the rule number one that I would want to tell everybody, and very easy to follow, is please diversify. The second is also equally important, is more to do with the kind of habit you can build, is staying disciplined with your investment via SIP. So it's essentially talking about consistency, right? You always tell your kids, please don't cram up before the exam. Start studying regularly so that the stress does not build up during the exam. Or if you are into, if you want to build muscles, you just don't grow muscles overnight or build muscles overnight, right? It needs consistent practice. Similarly, wealth creation, it is all about consistency. You've seen a lot of ads happening, coming out, talking about SIPs, the SIPs, a very beautiful concept, very important concepts for investing, and very easy. You don't need to have, or you don't need to start your SIPs with a 4 or 5 digit number in your bank account, right? You can start with as low as 500, as low as 100. Sometimes even you have 10 rupee SIP, 50 rupee SIPs. All of that is possible and easily doable. One more important thing that people need to understand is SIP is good, but do consider top up SIP. The idea is every year as you progress, as your salary grows, you need to top up or you need to increase your SIP. Now, if you can't do it actively, at least make use of top up SIP so that automatically your SIP also increases with every passing year. So that's rule number 2 for you. And rule number 3 is interesting. Mm, The way I put it is, do not drive looking at the rear view mirror. So what I mean is, when you're looking at past performance and investing, that's not the right way to invest. What you need to really understand is, if I want to invest in an asset class, what is the potential return, long term return of that asset class? What is the maximum risk that it can run? What are the volatility aspects? You need to consider the whole picture rather than just looking, oh, last year was a very good year for gold. I must invest now more in gold. That's not the way you go about investing. So do not look at the rear view mirror and drive. Do not look at the past returns and invest. So there's an, most of us know of this disclaimer with respect to mutual funds, which is mutual funds are subject to market risk. Please read all the scheme documents carefully before investing. So that's the standard disclaimer that all of us in this industry, mutual fund industry, especially have to know. But there's an interesting take that my CEO has, Mr. Gopkumar. He says, it should also read, mutual funds are subject to emotional risk. So what we mean by that is, it's not just market risk that you have to look at. You also need to understand how your emotions are attached to investing. Understand the risks of emotional decisions that you take. Uh, Take a holistic approach to investing and then invest. So that's the rule number 3 that I would want to lay out.
Those were very valuable advices, ma'am. So my next question to you would be, do the Axis experts advise on specific sectors or type of funds that are good for investments right now since the markets have corrected so much?
So Samruddhi, the way I would want to look at this question is, not advise or recommend on a specific sector, especially for investing, because looking at a sector could be more topical, or could be technically sectoral funds are quite riskier than diversified fund. But having said that, as active managers of portfolio, we do look at sectors very closely. We do have views on certain sectors where we want to be overweight on in our actively managed strategies. So there are some structurally positive sectors for us that we find are attractive. So, for example, let's say renewable energy. So there is a lot of emphasis that is happening from government, or globally also there is a move towards decarbonization. There's a lot of capex happening in the renewable energy space. So that is something that is new, that is upcoming, that is relevant in today's world. So that's a theme that we are positive on. Then there is this whole, make in India, made in India, push for self-reliance, self-sufficiency. That's also finding its way into the EMS sector, that is electronic manufacturing services sector. So there are these PLI schemes that government has come out with, which are all tailwinds that make us positive on the EMS sector. Then you have defense sector, again the emphasis of Make in India. There are a lot of projects, lot of orders coming up for in the defense space for the defense sector. So that's something we are positive on. But there's a larger theme that we are positive on, which is the consumption theme. So the latest news that we have is of GST rationalization. So no doubt, we think GST rationalization will aid in consumption, but there are other aspects also in play that we believe are, tailwinds for the consumption theme. Say, for example, the tax changes that came into play from this financial year. There are a lot of state activities that are happening, especially transferring or cash schemes for women. This is again incentivizing women to spend. Then the rate cuts that have happened. So there is already front loading of rate cuts that have happened that will again hopefully find its way towards consumption. So consumption as a theme that was going slow for some time, I think, or we believe that it has a good runway in the coming years. So these are some of the broad themes or sectors that I think, as an organization, we are positive on. So largely, these are also building onto the macro themes of urbanization, digitalization, self-reliance kind of an aspect. So I think from a medium to long-term growth perspective, these are some themes that we are looking at.
All right. Which schemes of Axis Mutual Fund would you recommend for SIP and why?
So because we are speaking to a broader audience, and I am not speaking one on one to a client to really advise on a scheme. I won't touch upon sorry, a specific scheme name, but there are broader categories that I feel are more well diversified in nature. So they take exposure across sectors, they take exposure across market caps, they are suitable for SIPs, and essentially they can be a part of your investors' core portfolio. So these are some categories which I believe can form part of your core portfolio. So one of the categories is the balanced advantage fund or the dynamic asset allocation fund. So these are like hybrid funds. These are hybrid funds. These are essentially investing in equity and debt. They have a model. Generally, usually they have a model which decides how much to invest, when to invest, how to switch between equity and debt. A very tax efficient way of switching between equity and debt. And because it happens, you don't have to take a call on switching. It happens at the fund house level. It's quite efficient. And the dynamic allocation also, we have seen that it has the potential to somewhere cushion the downfall when the markets are very probably overvalued in one sense. They have the flexibility to switch. So very ideal for conservative to moderate investors to build their portfolio as part of core portfolio in the balanced advantage category. The other category is flexi cap funds. So flexi cap funds, like the name suggests, they're very flexible in their approach. So they could be in large cap, mid cap, small cap, depending on the strategy they are following, depending on the fund manager call. They don't have any bias on the market cap. They don't have bias on the sector allocation. So essentially, because it's very broad, it can possibly help you manage risk by offering you a very well diversified portfolio. So that's one category. And finally, I think one category that's very close to my heart is the multi cap category. In a way, it is similar to flexi cap, but the difference is that in multi cap, there's a very stringent discipline of at least 25 large cap, 25 mid cap, 25 small cap. So that means that at all points in time, you have to be 25% invested in all the market cap. So irrespective of what the fund manager feels or the AMC feels, you always have 25, 25, 25 allocation in all the three market cap. The remaining 25 could be depending on your fund strategy or fund manager view. But that's a very disciplined approach to investing. It takes away the call of where should I be? Should I be in small cap today? Should I be in large cap today? It just takes away that call and gives you a very disciplined, again, a well diversified. I think these are the three categories which, depending on your risk appetite, you could be more or less, or you could avoid a category. But I think could find the way into an investor's core allocation.
All right, that was very informative of ma'am. Lastly, I would like to ask, for someone who's a beginner and looking to invest in the market, looking to start investing in the market right now, what piece of advice would you like to give?
So, so pulling out, from the points that I spoke of in this podcast today, first is if you are looking at near-term returns, so somebody who's coming and looking at the near-term returns of gold and saying, wow, gold has performed so much, I want to invest everything in gold. Please don't look at the near-term return. Don't look at the recent return. Study different cycles. Understand the potential of each category. Understand the risk more than the return. Understand the risk of each category, and then take a very detailed, informed decision of investing. If you are a first-time investor, be sure to start off slowly. Have your allocation diversified. So don't be greedy. Don't look at the past return, be greedy and invest all in and out, but be very careful with your allocation. Try to be in a strategy which in itself is well diversified. Like I said, right? Don't put all your eggs in one basket. Look at diversified portfolio, diversified funds. These are something you need to start off with. Start off slowly. And if you're investing in equity markets are very important. Okay, there's no need to shy away from investing in equity markets, because ultimately, if you want to create wealth over the next 10, 15, 20 years, a fixed income may not be the right way to look at it. Equities will have to play their role. So be invested in equity market, but then come with long-term investment horizon. Be ready that if tomorrow markets were to crash, I can still float. So if that strategy you have in place, please participate in the markets. Also, like I mentioned, right, I was giving you example of Formula One racing, right? So everything together, you have a beautiful car, a fast car, but if you don't have somebody sitting there studying and giving you strategy, that's not going to work in your favor. So you need, if at all you need help, please feel free to reach out to your distributor, to your advisor, seek help, and then you can begin your investment journey.
That was very insightful of you, ma'am. So thank you so much for this wonderful, valuable session. Thank you so much, ma'am, for this valuable session. I'm sure our viewers must have learned a lot after today's session, and they must have gained a new perspective as to what their next decisions on their investment should be. Thank you so much for being with us today.
Thank you so much. Thank you so much for